Rob, I mean, it's jarring. It was such a bad time, March 23rd at the lows. How is it possible that we test it again?
Well, Dom, thanks for having me on this morning. And yes, in my notes to you, I did mention that we possibly could retest the March 23rd low of 2237. But the farther away we get from that, and we're almost 3 or 4 months away from that, it becomes less likely. And on balance, I am very optimistic and positive on stocks right now, but I think it's good to remind clients that retesting lows in a market rally is always a possibility.
All right, let's say it's a possibility. What exactly would have to stack up? What kinds of events would have to happen? Because it has to be a lot of them for us to really go back that low to the depths of that kind of market that we saw during the height of a pandemic. I mean, it seems to me as though you'd really have to get a massive resurgence and a huge economic shutdown. Both things, by the way, that, yes, are possibilities, but that most experts believe will not happen.
Well, yeah, and I would tend to agree with you. We're in a very strong economic recovery right now, even though the Atlanta Fed president said we're seeing some leveling out. The administration has vowed that we won't have a second shutdown. So I would say, to answer your question, what factors would need to stack up? The administration would need to go back against their vow not for a second economic shutdown. And also, too, the Fed has vowed they're going to print money until they achieve their dual mandate, full employment, 2% inflation. We're a long way from that. So perhaps there'd be some kind of catastrophic event that would cause the Fed to renege on that. I can't foresee what that might be, but I guess those are a couple of factors that might prompt retesting lows.
I feel as though we're all very keenly aware in the world of financial news and surely on Wall Street as well, all of the criticisms of the Fed and its policies, that somehow down the line we are going to have some massive amount of financial kind of chaos because of what's going on right now. And that may very well be a possibility, but we are nowhere near the inflation levels that the Fed would get scared about. We are certainly not near full employment right now. Can the Fed just keep doing what it's doing with that kind of leash and latitude because we don't have any threat of having any of those real bounds tested anytime soon?
Yeah, absolutely, Dom. Certainly for the short term and the intermediate term. For the longer term, I mean, the Fed balance sheet keeps expanding. It's probably going to get up to $8, $9, $10 trillion. That's certainly a possibility, and that's a big balance sheet. And in the long term, they would have to start to unwind that. But that's way down the road. The stock market investors typically their view isn't that far down the road.
All right, so let's come from way down the road back into, say, like the next 12 to 18 months, because we are looking for ideas here. What exactly then should investors be doing, given the fact that the Fed is kind of in play? The real ramifications don't happen until, years, maybe even a decade from now. How exactly do you position given that kind of environment?
Well, I think broadly speaking, Dom, investors should continue to at least market weight stocks. If investors sold out of stocks in March when this first hit, they probably want to start getting back to whatever their asset allocation level is for stocks. Then a little bit more in the weeds, since the Fed bias is going to be to print money, that's going to nudge the dollar down. That's going to help large cap growth stocks versus small cap value stocks. And then as far as sectors go, the S&P sectors look attractive right now, and you can see them on the screen. Consumer discretionary, financials, and telecom. Those all look valuation-wise attractive. Technicals look good, and there's some earnings visibility there.